The Big Short's Michael Burry explains why index funds are like subprime CDOs? Oh no, this is so sad. I love index funds and ETFs, not them. But Michael Burry is very trustworthy. You know this guy, right? From The Big Short. Made tons of money in 2008 because he saw what was going down. And before that, he was actually an investment banker on Wall Street, but things got a little crazy, so it didn't really work out for him. So to make up for that, he became Batman to cleanse all his sins and fight crime until he returned to Wall Street to make all that money in the crash. And now he's saying that another 2008 style crash is about to happen with these ETFs. So he's saying central banks and Basel, I think that's how you say it, Basel III have more or less removed price discovery from the credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore. And the Basel III is basically this thing right here that was just regulations for banks. So enhanced minimum capital and liquidity requirements and a bunch of other stuff to make banks safer. But of course, every rule and regulation you put in place has adverse effects, such as screwing up the market's pricing mechanism like Michael is talking about right here. So he's saying on top of that, in the credit markets where things are all getting screwed up, passive investing has also removed price discovery from the equity markets. He says you got all these simple theses and models now that get people into sectors, factors, indexes, and ETFs or mutual funds. But these strategies don't require the security level analysis that is required for true price discovery. So people aren't, doing fundamental analysis and trying to pick stocks. It's just a bunch of money flowing into a few models. And the most popular model right now, as you know, is the passive investing model, which is just buy and hold. And it's not really worried about what stocks it's getting into, it's just worried about the fees. How much are they charging? As long as it's a low fee, everybody's happy, so they just pile their money in. He said this is very much like the bubble in the CDOs before 2008, in that price setting in the market wasn't done by fundamental security level analysis, but by massive capital flows based on noble approved models of risk that proved out to be untrue. So in 2008, they thought CDOs were safe and were a no-lose situation, so they were just piling money in. Same thing with ETFs and passive investing now. No one is thinking about the downside. And another reason people stop thinking about the downside is when they have too much money. And central banks have been keeping interest rates super low, artificially low for a long time. So there's a ton of money in the system. That creates a lot of wealth disparity because all that money goes back into the market. So the top group of people are making more and more money because there's more and more fuel going into the fire. But there's so much money that people aren't being smart about those investments. They're just piling it in. And it becomes a reflexive loop like Soros style where it keeps pushing everything higher. But again, there's risk to this stuff that people are just forgetting because too much money and it's got to go somewhere. Same reason why so much money was going into all these venture-backed companies. And now they're all IPOing one by one with just like ridiculous fundamentals, not making any money at all. But they've almost been trained to not make money because they're getting so much money from this low interest rate environment. Anyway, so the big problem with passive investing and all these ETFs is liquidity. So if you think about the Russell 2000 index, for instance, as he explains here, the vast majority of stocks are lower volume, lower value traded stocks. So he counted 1,049 stocks that traded less than $5 million in value during the day, and almost half of those traded less than $1 million during the day. Yet through indexing and passive investing in these ETFs, hundreds of billions of dollars are linked to stocks like this, these tiny little stocks. And the S&P 500 is no different. It contains the world's largest stocks, but over half of them trade under $150 million today. Now that sounds like a lot, but trillions of dollars in assets globally are indexed to these stocks. So he says the theater keeps getting more crowded, but the exit door is the same as it always was. And all this gets worse as you get into even less liquid equity and bond markets globally. So Michael Burry is getting into the structure of these ETFs here. And what ETFs do is match the performance of an index, right? But at the end of the day, they're still financial derivatives. They're created artificially. So sure, they work fine when the market is going higher and isn't too volatile because everyone just keeps buying and it's okay. But what happens when the market turns around and goes lower for an extended period of time or it becomes super volatile? So he said it can be really bad because of the impossibility of unwinding the derivatives and naked buy-sell strategies used to help so many of these funds pseudo-match flows and prices each and every day. So again, these index funds are using derivatives and other things to match that index because they have to do it artificially, right? So he says this fundamental concept is the same one that resulted in the market meltdowns in 2008. So he doesn't know what the timeline will be for this one, but like most bubbles, the longer it goes on, the worse the crash will be. So here's a different article that explains how ETFs actually work. So the ETFs work with ETF market makers, and these are authorized participants looking for arbitrage opportunities. So when you're buying and selling, they're taking the other side. So they trade dynamically to balance the supply and demand for ETF shares and their underlying assets. But if liquidity in underlying markets suddenly dried up, market makers would likely price that risk into their ETF quotes. So in effect, ETFs track not only the performance of their underlying assets, but also the liquidity of these assets. So ETFs targeting illiquid instruments like corporate bonds and leveraged loans would present greater risks, and investors trade trading on the premise that ETFs are more liquid than their baskets might find that results fall short of expectations in a stress environment. So okay, this problem would be the biggest with specific sector ETFs like the HYG high yield bonds or something, because there's a lot of money trading on that ETF but not as much supply of actual bonds, especially if liquidity dries up, as in people don't want to buy and sell those bonds anymore. The people trying to get out of the ETF might get screwed, because if the person managing the ETF can't even buy or sell, they're going to reflect that in the price of the ETF. So you might wake up one morning and it'll be down huge and it's not even matching the index. And another scary thing is that these ETF market makers, these authorized participants, if I'm understanding this right, it's a little complicated, but they don't even work for the ETF company, meaning that they don't have to trade with the ETF. So they don't have to take the other side of your trade. So if something really bad happens, all those authorized participants, they could disappear. Then you have no one to sell to, and then you see a huge price drop. So that's another structural risk with ETFs and these index funds. It's just all about liquidity. And these things haven't really been tested before because we've had such an easy market, and we've never had this amount of passive funds all in these index funds. We're like at the height of the bubble right now. I think the stat that I saw said that passive investing is going to pass active investing as far as total AUM by 2022. So whenever things swing way too far to one side of the market, they always swing back. It's like a pendulum. So yeah, we've been in a long period of active investors underperforming the market, which has pushed people into passive, because they're like, why am I going to pay for you? You suck. You can't even meet the market, where I could pay just a tiny fee and get in this index fund and it'll do great. It'll just match the market at least, which is much better than what most active managers were doing. But it's all about the environment, right? So where Michael Burry was saying that price discovery isn't happening anymore, well, if that's not happening, the managers aren't going to do as well, right? Because they make money on finding those discrepancies between what the market is pricing something at and what it's actually valued at. But if there's just this wave of money coming in and everything's just floating up together, then what's a manager supposed to do? And I remember in Stan Druckenmiller's interview on Real Vision, he was talking about the same thing. All these price signals are getting washed out, but this will only happen for so long until this all falls apart, like Michael Burry is talking about. There's way too much money in passive, and then you get the washout and crash, and then everyone wants to go active again because it starts working again. It's just long-term cycles that people can't handle. So what does this mean though? Can you not use ETFs anymore? No, that's not true. I'm still using ETFs in my systems. I was just talking to Keith today from Market Gauge, my mentor, the guy I build with all these systems with. And what he was explaining to me is that this doesn't even matter. The bigger problem is that so many people are just in passive in general, which is just a bad strategy because there's no risk control. So even without these index funds and ETFs, if you're just passive, you're going to take that huge haircut when it comes anyway. And what you should have is risk control in place. So in one of our systems, we use ETFs like SPY and TLT, but we have stops there. We have a stop below our entry in that system of like 6% or something. Well, when this crash happens in the ETFs, it's not going to happen all in one day. Even in 2008, the crash didn't happen all in one day. It took a period of time. Well, if you have risk control in place with your stops, they should get you out of the market before the huge crash happens. Like I said, in our system, if we got to stop at 6%, we're going to get out at 6% and then we're going to be fine. We're going to be in cash, because this whole structural problem with the ETFs that I'm talking about, that won't trigger at just a few percentage points down. It's going to trigger once everyone starts selling at the same time, and that happens when there's true panic, which should happen after the market falls lower than 6%. It's just the thing starts cascading and it picks up steam after a certain point because of the way all this money is grouped in together now. So feel free to still use ETFs, but be careful. You need that risk control in place, not only to protect you from the natural market crash, but also from how these things are structured. They're all financial products, which are never created 100% correctly with no risk. There is always risk with financial products. But okay, if you have any questions, put them down below, and also let me know what kind of videos you want to see from now on. We're trying to get some ideas about what you like, so let me know in the comments and we will make those videos. And by the way, if you comment on one video with your suggestion and we don't make that video, it's okay, just keep commenting so we see it again. We got like this running list and things get moved, but if you keep commenting, we'll be like, oh, they really want this. Okay, if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get an email notification whenever our new videos come out. We are publishing all the time, all about markets and business. So subscribe, and I will see you in that next video. Stay fallible out there. Bye.